Welcome back to Protecting and Preserving Wealth. I'm John Gay, and I'm joined by Bruce Hosler and Alex Corey of Hosler Wealth Management. Always good to be with both of you guys.
Thank you, John. It's great to be with you.
Same here, John. Hope all is well.
All right, so today we're going to cover a topic that we've really hit on in previous episodes, but it can't be underscored the importance of it, and that is solving for the concentrated stock position. When you're invested, you do not want to be over-concentrated in one area. It's the proverbial putting all your eggs in one basket. You want to be diversified. So diversification is our topic today. Bruce, where do you want to start?
John, the stock market has been great this year, and we have been meeting with new clients, and we are finding a lot of people that have been successful in their investments, whether it be with Apple or Nvidia or Tesla. And what happens is when someone invests in one of these stocks that has done well, and they've held the position for a few years, all of a sudden they have a problem. And the problem they have is capital gains tax. And they want to avoid the capital gains tax so they don't sell the position. And so it just festers and becomes worse. And now this concentrated stock position becomes dominant in their portfolio, and they are struggling with what the answers are. So Alex and I want to talk about what they can do on some of these positions. And foundationally, I want to start off with, and Alex, I'm going to have you kind of jump in here with me. In Arizona, we are a community property state, and sometimes the clients will make a decision. Bruce and Alex, I love this stock. Let's say it's Apple. I love this position. I don't ever want to sell it. I just want to hold it forever. Well, one of the things we can do is if we hold it until one of the spouses dies in the community property states, the surviving spouse can get a full step up in basis and not have to pay any capital gains tax. Alex, do you want to talk about that for a second?
Yeah, so what we want to be aware of is when it comes to your capital gains taxes, and a reason why you maybe don't want to sell your stock at all is at the death of the first owner of that stock, if you're married or joint tenancy. Again, when one of the original owners dies, there's what's called a step up in basis to the date of death of the first person that passes away. And that will raise your cost basis up to the date of death. And that helps eliminate some of that additional capital gains tax risk you may have on that specific position.
So that's a foundational place if people are old enough. But what if they're younger? We have some other strategies. Let's talk about exchange funds. So we have a client, they have a concentrated position in a stock. They probably should diversify. They shouldn't maintain that. So when we're looking at the opportunity at exchange funds, we're looking at taking that stock and exchanging it for what? What is the client exchanging it into?
So in an exchange fund strategy, what a client or investor is exchanging into is actually a basket of stocks. So it could be based on the S&P 500 as an example. What that achieves for a client is, number one, let's say you have a stock like Apple. Let's say it's worth $1 million a day. You can take that stock, not sell any of it all, not generate any capital gains, and you move it into this exchange fund for immediate shares of, let's say, Nvidia, Google, Amazon, just a diversified basket of stocks. And in that exchange, we're not realizing any capital gains. You still own that particular stock, but your risk actually becomes diversified at that point because now you actually hold or own in exchange for your share of Apple stock, a basket of stocks instead. And the nice thing about that is over time, what that allows for, if you think about it, is diversification, number one, a better capital gains tax strategy, because now we can do better tax planning for you around those bigger positions in your non-qualified brokerage accounts and other advisory accounts. And at the end of the day, if you decide after 6 years or so that you still want to keep your original stock and you want to give the exchange fund back, you can actually still maintain that individual holding at a later date in time. So there's a lot of reasons why you may want to consider that as part of your strategy. There are some qualifications for that. Number one, you must be what's called a qualified purchaser. And that means you must have a liquid net worth of over $5 million for the specific strategy. But it may be attractive for folks that do like the idea of diversification, but they don't want to have to sell all their stock up front and pay that big capital gains tax.
So I want to make sure that we reiterate, folks, this is a non-taxable event. So you take your stock, you contribute it to the exchange fund. In return, the exchange fund gives you shares of the exchange fund. That is a non-taxable event to be able to diversify your risk away from your concentrated stock position.
You know, we've talked about the Magnificent Seven in previous podcasts, and a lot of the examples you're using today, Apple, Nvidia, things like that. If you have X amount of stock in one of these companies and it continues to keep gaining and gaining and gaining and rising, now you may have a disproportionate amount of your portfolio in this stock because it's gone up so much in value. These strategies the two of you are discussing today really have to do with mitigating that risk and doing it in a tax-free way.
Yes, diversification. We're avoiding the concentrated stock position of having, you have a $2 million portfolio and half of it is in one individual stock.
Right.
That's too much risk in one individual business, be it as good as it was. I mean, think back in the day when I was a younger advisor, back in the 1990s, GE was like a company that you would want to own. Well, you look at GE today and it's fallen from grace. You may not want to continue to own that. So you want to diversify away from these positions. Maybe you think Apple is invincible or Nvidia or whatever today, but sometime in the future, 5 years, 10 years, 20 years, it may not be as good as it is today. And you may not want to continue to hold that. You have to find an ability to get out of that position. I want to move on to our next idea in this area of dealing with mitigating the concentrated stock risk in a portfolio, and that is with direct indexing, where we can take your stock position and again involve it in an direct indexing fund or investment portfolio. Alex, tell our listeners about direct indexing.
So what direct indexing actually is let's take, for example, again, the S&P 500 index. Now, in this example, you actually would own all 500 stocks in the S&P 500 index. And why would that be advantageous? Why would you just buy some other type of index fund instead? Well, in an index fund, let's just say in the S&P 500 in general, we know that not all stocks in any year are profitable. Some of them are going to be down. They may generate some losses for you in your portfolio, and some of them are going to be up. When you own it in an ETF exchange traded fund wrapper, whatever the S&P 500 returns is what you get as a net number. But if you can imagine, there's going to be stocks in your portfolio in the direct indexing model that are going to generate losses in that portfolio. And what a direct indexing fund actually allows you to do is take those capital losses to net them against the capital gains you have in that individual stock portfolio. So over time, it's a time strategy that over time you can liquidate your stock, okay? Use those losses that are generated from the S&P 500 index of the losers of the index that year, and then have a zero capital gain risk going forward. And we can do that over many, many years to unwind those larger positions in this direct indexing strategy.
So it allows you to diversify your concentrated stock position without just selling at a gain. You'll still have to sell those positions at a gain, but you'll have accompanying losses in the direct indexing portfolio that offset the gains in your concentrated stock position. So slowly we unwind that concentrated position using the losses of the other positions in the portfolio. Very, very good, folks. Let's talk about the unified managed accounts. So unified managed accounts allow us to put together your portfolio, whether it's individual stocks, some ETFs, some mutual funds. And again, the same type of thing works where inside that unified account, we can buy or sell stocks, ETFs, mutual funds that have had gains and sell the ones that have had losses in the same tax year, offsetting those capital gains, allowing you again to diversify your loss. I don't know, Alex, do you have any other thoughts you want to talk about the UMA accounts?
The UMA, the Unified Managed Account Strategy, is really diversified among actively managed SMAs or separately managed accounts, and also some of our own managed accounts that we have for our clients as well. So it's a little bit like the direct indexing model, but a little bit more actively managed instead. So you don't just get the index, you actually get actively managed stocks, ETFs, and mutual funds as an example there. But it allows you to do the same exact thing as realize and recognize over time capital losses every year to offset your capital gains risk in your individual stock portfolio just as well. So by the end of the process, you would be fully engaged in this UMA model instead, again, achieving diversification and long-term growth prospects that you have. I mean, you've taken a lot of risks just to earn that return or that big unrealized capital gain in those bigger stock positions. But then the question, of course, just becomes, again, how do you unwind these things? What are the strategies around it? What makes sense from a perspective of your tax plan every year? How do you pay less tax every year? Well, these are some of the ways you can actually achieve that.
I want to make sure that we clarify SMA is a separately managed account. So that's where we can, as advisors, hire money managers in a specific area. Maybe they specialize in small cap or mid cap or maybe even some private equity or something like that. But there's a third-party manager, a separately managed account that is held inside of the UMA. And those managers can be offsetting losses against gains, harvesting losses, and they can actively do that for us. All right, let's move on to our last and final kind of topic for this show this week, charitable giving. So certainly if you've had a very good year or you are going to contemplate selling something at a large capital gain, we want to talk about donor advised funds very quickly and charitable lead and remainder trusts. So a charitable remainder trust or a charitable lead trust. So folks, if you have a concentrated or highly appreciated stock position and you're contemplating a donor advised fund, you can donate your stock to your donor advised fund without recognizing the capital gain. And you receive the donation on the fair market value of your investment. So if you invest in a position and it grows, let's say it doubles, and then you give that doubled amount away to your donor advised fund, now you can receive a tax deduction for that year equal to the fair market value of that position that you gave away. And you can then write that off against your ordinary income up to 50% of your ordinary income. So you have to have enough ordinary income.
Well, Bruce, I know moving to tax-free is a passion of yours and the team at Hosler Wealth Management. In fact, it's even the name of your book.
We love increasing your income to take advantage of your donor advised fund by making a Roth conversion. So we can cover you every way, whether we're increasing your income or minimizing your income with the deduction on a donor advised fund. The other one with a charitable lead or charitable remainder trust, those are great. You can give your position away to your charitable remainder trust and again, take income for your life and your spouse's life, maybe even for part of the lives of your children. It's a great source of income, but you still get a charitable donation on that. And so there's a lot of planning that can go into these concentrated positions and minimize. Alex, is there anything on charitable giving that you want to comment on?
Those are the main ones. I think a lot of people are used to giving cash. You make a donation, you give cash. That's typically how it goes. But again, think of your taxable brokerage accounts that you have and look at your appreciated assets in those portfolios and consider instead using those more strategically to gift those stocks away that you could give away over time. And that way you get a tax benefit up front. The charity gets a benefit when you donate out of the donor advised fund, as an example. It's a great tool you can use for your family to get around, say, during the holiday season and talk about what charities mean the most to you and give a little bit away every year. And it could be another legacy asset that you can actually grow over time just as well, to be something that would help your family and others remind them of you in those times of giving when you're no longer around.
And that's an important part that I want to remind our listeners here. On the donor advised fund, you don't have to give all that money to a charity that year. You have the ability over a number of years to carve off a portion of that each year. Let's say you have a big position, maybe it's grown to 50 or 100,000. You're like, Bruce, I don't want to give that all to one charity this year. That's okay, folks. You can give it to your donor advised fund and then give out $5,000 a year or $10,000 a year to the charities that you love and want to support. And if somebody else comes up, you can give that away, but you can make your giving last over a number of years, even though you made a big donation in the first year and you had a big deduction, which we can use to help you make a Roth conversion or do other tax planning with.
It's interesting as we got into today's podcast, I was thinking about how diversification is so important and not being concentrated in one area, but you two have really dove into avoiding taxes. I know the book you wrote, Bruce, is Moving to Tax-Free. There are so many strategies here, and it really speaks to your expertise at Hosler Wealth Management as far as all these different vehicles to help anybody with their individual situation. Bruce, if our listeners want to get in touch with you and the team to talk about any of this, we're going to give your contact information in just a moment. But before we do, a quick disclaimer. This material is intended for informational, educational purposes only and should not be construed as investment advice, a solicitation, or recommendation to buy or sell any security or investment product. Please contact your financial professional for more information specific to your situation. Diversification does not assure profit or protect against a loss in declining markets, and diversification cannot guarantee that any objective or goal will be achieved. All right, Bruce, how do our listeners best find you for more information?
Hey, they can find us at the website at hostlerwm.com or call us at one of the offices in Scottsdale, 480-994-7342, or in Prescott, they can reach us at 928-778-7666.
Great stuff, gentlemen. We'll talk again in a couple weeks.
Thanks, John.
Thanks, John.
Securities and advisory services offered through Commonwealth Financial Network, member FINRA SIPC, a registered investment advisor. Forward-looking commentary should not be misconstrued as investment or financial advice. The advisor associated with this podcast is not monitored for comments, and any comments should be given directly to the office at the contact information specified. Any tax advice contained in this communication, including any attachments, is not intended or written to be used and cannot be used for the purpose of 1. Avoiding federal or state tax penalties, or 2. Promoting, marketing, or recommended to another party any transaction or matter addressed herein. The accuracy, completeness, and timeliness of the information contained in this podcast cannot be guaranteed. Commonwealth Financial Network does not provide legal or tax advice. You should consult a legal or tax professional regarding your individual situation. Accordingly, Hosler Wealth Management LLC does not warranty, guarantee, or make any representations or assume any liability with regard to financial results based on the use of the information in this podcast.